Hey everyone, welcome back to Corporate Decoded, the place where we decode the language of business. Today we're diving into T-Rex Acquisition Corp's latest report. Get ready, because this report is less about roaring and more about, well, maybe a whimper. You might even say it's like finding out your pet dinosaur is actually a lizard with a really good marketing team. T-Rex Acquisition Corp just filed their financial report, a Form 10Q, for the 6 months that ended in December. In simple terms, this is like a report card for the company showing how they did over those months. So, who are they? T-Rex Acquisition Corp is trying to make a name for itself in the world of cryptocurrency, specifically Bitcoin. They're doing this through something called mining, which is like solving complex puzzles to earn new coins. Think of it as a digital treasure hunt where the prize is Bitcoin. Here's the thing though, they've had a bit of a rough patch. Their mining operations were put on hold because contracts for their mining locations ended. That's like losing your pickaxe in the middle of that digital treasure hunt. They did secure a new contract to resume mining at a single location, and they're also exploring some business opportunities, but there is no guarantee that the company will be successful in consolidating operations. Now let's get into what's important to investors. This report restates a previous one with slightly more accurate accounting. T-Rex is taking care to properly account for all the goods and services that they are using. Also, it's important to note that the company does transactions and exchanges with individuals connected to the company, which can be a risk. Looking at their income statement for the 3 and 6 months ended in December, the company mined revenues of exactly $0. This is very bad, as mining and cryptocurrency colocation are the primary sources of revenue for the company. Its costs of goods, however, were not exactly $0, and the loss from operations was over $600,000 for 6 months. They also had to pay interest, costing them a significant chunk of money, and another almost $100,000 hit from something called derivative liabilities. Basically, because the value of the company is volatile, they needed to pay out more money. The company is not in a good position when its expenses are more than its revenue. So how does all of this affect the value of their stock? Well, their net loss per share for both basic and diluted shows a loss of 4 cents per share. So investors are losing money when they buy the company's shares. Moving on to the balance sheet, the company does have over 18 million shares that are outstanding. The company issued these shares for debt conversion, services rendered, and subscriptions. Stock subscriptions payable are almost 500,000. There are a lot of shareholders who believe in T-Rex. However, in this financial picture, T-Rex has an accumulated deficit, which means that the company has way more liabilities than assets. This means that there is high risk that the company will be unable to pay for the business liabilities and will fail to perform. To add more to that, there was a net loss during the last year, which does not bode well for the company or its investors. In order for T-Rex to pay these debts back and to prevent the company from losing money, it needs to increase its revenue so that its profits can compensate for its debts and expenses. The company is still involved in several risk factors with lawsuits, claims, or judgments due to poor risk management. T-Rex needs to better handle these risks, or it may suffer heavy losses. Also, the company needs to keep track of the value of their financial instruments in a fair way, and there are different levels to fairly valuate them. Fair value of financial instruments policy describes the market value of its notes payable at $357,000 on December 31st, 2024. The company consolidated all its own subsidiaries, which is the right approach because it gives one clear picture of T-Rex's financial position and performance. As of December 31st of last year, the company had a deferred tax asset which could be recognized in future periods. However, there have been tax losses and a valuation allowance which shows a negative of assets due to the net loss, so take that into account. Furthermore, there were many non-binding agreements and commitment to lease equipment which could or could not materialize, and so these risks make it hard to predict the future of T-Rex and its value. There is significant debt due to related parties that the company needs to take account for and pay to provide full transparency. Management is leasing office space from its president at a cost of $250 per month, which is a related party transaction. Very low cost, but a conflict of interest nonetheless. Based on these documents, it looks like T-Rex wants to continue developing its business plan, generate greater revenue, and increase its ability to secure investments. The goal is to make mining operations more profitable and create stability for the company. However, it seems like it may not be the best investment choice at the current moment based on its financials and its strategy. T-Rex has trouble managing cash flow that is used for daily operations, investing, and financing, as shown by a cash flow from operating activities deficit, a net decrease in cash, and supplemental cash flow information regarding interest that needs to be paid. Cash balances are also very small at around $100, which shows high illiquidity. It is also important to consider that their chief executive officer believes internal control over financial reporting is not effective. The staff is limited and its accountability is questionable. Many expenses are being paid in advance, which indicates T-Rex is trying to delay incurring them. As of December 31st of last year, these expenses were close to $80,000. They did adopt a more transparent method of valuing their revenue on the trade of Bitcoin. However, their mining revenue is zero, and so it did not factor into their financials much. Many shares were issued for services, which inflates T-Rex's market cap, but without actual cash inflow, it will be difficult to repay investors. Many warrants were also used in this 6-month period. So shares have been surrendered before, so there is precedence that what you see on the books isn't fully real. It's important to note, and the company says so themselves, there is substantial doubt about the company's ability to continue as a going concern based on its finances right now. In conclusion, T-Rex's future is uncertain, and it's important to be aware of the significant risks, such as the high debt that T-Rex has, and that they may be unable to pay that debt. A reasonable price range would be about 1 cent to 3 cents per share, as the market sentiment is very weak based on the financials as seen with its losses and deficits. Therefore, T-Rex has a bearish outlook. Thanks for watching, and if you enjoyed decoding this with me, please like and subscribe for more corporate breakdowns.